VM Hegde saying, should we exit Bank Nifty shorts put on intraday, short Bank Nifty? So you have bought puts, right? As just a moment ago, I have shared this with you. Now you can see it's not really working out. It's going up. The VWAP has turned flat. I would not be too keen on a short now. Even if I had taken a short, this would have taken me out. I don't want to risk much. Now again, if I have to short, I would wait, let the market go down, let it pull back, and do this kind of a thing instead of like chasing the price down again. That is not a good idea. If it just falls, it falls, and I miss the trade. I have no issues with that. But waiting for a falling VWAP is always a good idea. Yes, like if you see now the price should not be dramatically different from what it was here and what it was here in case of puts. But today being expiry, you can never be too sure, so you can get out of your shorts if you have. See, the issue here is that let's say you have some shorts yesterday. Let's say you bought some put because there's a lower value area and all those kinds of things. You expect continuation to the downside, and you get one. Now there are multiple ways you can handle this trade. Let's say you were short futures. Now you can put precise stop loss levels, like maybe the VWAP. As soon as it tags the VWAP, get me out of the trade, something like that. Or you can use percentage retracement from the bottom. So if it retraces a certain amount, whatever range you want, you can put I'm not a big fan of this, but let's say I put this nice Fibonacci retracement here, and then I will monitor, like, okay, if it retraces let's say 25% from the lows or 20% from the lows, I'm out of my trade. So if it does that here, you exit your shorts. You don't like to use this whole big range, you can reduce it. Let's say make it from yesterday's close to the low, and you can have some figures, 25%, 30, 40, whatever you prefer. There are no golden numbers here. Okay, so you can use something like that, simple, 25%, 50% of my position, 75% of my position, something like that. 20% retracement of the bottom, I'm out. Or you can use these ratios straight away, and that would also give you roughly similar exits. So you can do that, and you should have a plan like that beforehand before entering a trade. Otherwise, what will happen, I'll tell you. Let's say you take a short put here. Okay, sorry, I mean you buy a put here. You have Bank Nifty short. Market opens lower. If you get out, let's say you bought a put for 100, now it is trading at 320. You get out, and then 10 minutes later you find it trading at 400 rupees. Now you'll kill yourself. Why I should have waited, I should have used a trailing stop and this and that. Other case, it is now at 320 and you are very bearish, market recovers and now this drops to 250. Now you are again beating yourself up. Okay, why I should have immediately squared off, I would have made 70 points more, something like that. So the point here is that if you are doing something like a BTST, which is precisely what this is, if you have bought yesterday put, and unless and until you have reasons to believe that, okay, this is going to the ground, and it shows you confirmation for that, and other indicators also show you confirmation for that, then probably it is a wise idea to hold on to your trade. Otherwise, you should have an exit plan beforehand. Otherwise, puts, especially on expiries, can move very, very widely. As we all know, the gamma thing comes into picture, and they can gain value and lose value very, very quickly. So you can make big profits or lose accumulated profits or make big loss very, very quickly. And that is especially true for expiry day. So if you have a BTST kind of a position, you should come in with an exit plan, be happy with whatever exits you are getting the next day, and then decide, like, let the day develop, and then again you can take a call whether you want to take an intraday trade or something like that. It's a different story. But if you're taking overnight positions, especially in options, you should have an exit plan right at the open, unless and until like you are expecting it to gap down by 200 points, and you are prepared for 200 point gap, and if it gaps down 500 point and just continues from the get go, that's a different story. But if you were expecting, okay, that market might come and test this low, and it is testing that low, you get out. Whatever premium you get out. So that is how I would trade it.